Hello, everybody. Thank you for joining us. This is the Traders Exclusive Live Trader Showcase for September. I'm Sherry. If you need me for anything, please email me at support@tradersexclusive.com. And we're so happy you could be here with us. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and strategies. That's also where you're going to find a recording of today's webinar. And of course, we always get started with our disclaimer, where you should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. This is teaching and training. Please check it out for yourself. Do your due diligence. Past performance is not necessarily indicative of future results. Simon Ree of Tao of Trading. He's going to talk to us about the magical formula for rapid account growth. He's a best-selling author. He's the founder of the Tao of Trading. Simon has worked as a professional in the financial market since 1992, when he started his career as a futures broker. He loves studying the markets, trading the markets, and he loves traders too. During his 28-year career, he has worked at Goldman Sachs, where he founded and headed up the markets desk in Sydney. He subsequently held senior positions at Citibank in Singapore. During this time, he developed considerable expertise in financial markets, with a particular emphasis on stocks and options. So he is the author of the #1 Amazon bestseller, The Tao of Trading, How to Build Abundant Wealth in Any Market Conditions. So you can Google. May be able to get you a link for that too. Simon's passion extends beyond trading the markets to analyzing the markets, talking and writing about the markets, and teaching others how to trade the markets. Since 2017, Simon has successfully mentored hundreds of aspiring traders on the simple techniques he uses to generate consistent cash flow from the stock market. Thank you so much for joining us, Simon. Let me just see if I can make you a presenter. And there you go. Now you're muted. It says they're muted by me. There you go.
Okay, can you hear me?
Yes, there you go. And I can see your screen too.
It's all working. I love that.
Yay. Thanks for being here. I'll mute myself and you take it away.
Thanks for the introduction, Sherry, and thanks everyone for joining. I'm really excited about this class. My goal with a class like this is to give you a couple of aha moments, but really to show you some things that you can start using in your trading straight away as soon as you leave this class, and frankly, help you plan out the next 5, 10, 20 years of your life from a wealth creation perspective. At the end of the class, I will share details of how you can work with me more closely if that's what you would like, and also share some details of how I make my living from the stock market every day. So without further ado, this class is going to be really relevant to you if you're a wage or salary earner without a strategy to grow your income more quickly than inflation. Yeah, look, I know the CPI is coming down, but I think we all still feel the pressure when we dine at a restaurant or buy groceries or buy an airline ticket anywhere. Maybe you're concerned about current market volatility and the potential for a recession and further declines in the stock market. If you are, stay tuned. Perhaps you've just been frustrated by market choppiness, lack of trend, and limited follow-through on many moves over the last month or so. Maybe you're stuck in a job answerable to a boss that you don't particularly like, and you're looking for ways to become your own boss. Trading can certainly do that for you. Or maybe you're simply wanting to learn how to profit from trading so you can retire sooner or richer or both. I'll make this intro really brief because Sherry did such a great job. I've got a Bachelor of Economics and a Graduate Diploma in Applied Finance, and I've worked in the markets since 1992. I want you to know that I have been through the mill myself. I've experienced the highs of big wins, but I've also experienced the pain and frustration and confusion of financial loss firsthand. So if you've been through that, I've been there as well. I retired from the banking industry in 2017 with the vision to help people live more creative, joyful, and inspired lives by alleviating the burden of financial stress that weighs so many of us down. And my mission is to revolutionize the way finance is taught by shattering long-held Wall Street myths. I should know I worked for Wall Street firms for more than 2 decades. And look, since 2017, I've helped thousands of traders become more profitable in the markets. I worked at Goldman Sachs for 14 years, where I did was the founder and headed up the markets desk in Sydney, and I worked at Citibank in Singapore between 2010 and 2016. You can probably tell from my accent I am Australian, but I live in Singapore. This is where I'm based. I'm the author of the #1 best-selling book, The Tao of Trading. It's one of the highest rated options books on Amazon, and it was a #1 bestseller in 5 different categories. And I'm also a Jeet Kune Do instructor. All right, Jeet Kune Do was the martial art developed by Bruce Lee, and he was the inspiration behind the name of my book and the name of my business, The Tao of Trading. So what we'll cover in today's training is we'll look at the quickest way to build wealth while managing your risk. We'll look at the major difference between trading a bull market versus trading a bear market. We'll talk about how to make money in any market condition by exploiting both trend and counter trend conditions. And then we'll look at the keys to successful risk management, which is so important because it's risk management that keeps you in the game over the long term. So the quickest way to build your wealth while managing your risk. Well, there is a secret formula to this, and I'm going to share the secret formula with you up front. It is strong risk control plus intelligent use of leverage. So the focus of our approach to trading is bringing these 2 essential ingredients together, and everything that I'm going to talk about over the next 45 minutes or so is going to incorporate strong risk control and smart use of leverage. So how can you create consistent gains in a volatile stock market? With high valuations, tightening liquidity conditions, and deteriorating economic conditions, the stock market environment makes it a trader's market. Buy and hold and hope just doesn't cut it in this type of environment. You need to know how to identify high probability moments in time to expose yourself to risk rather than being exposed to risk all of the time, just hanging on and hoping that everything will keep on going up. Being able to identify high probability moments in time while controlling our risk is what enables us to use leverage intelligently. That's it in a nutshell. But isn't it impossible to time the market is a really common question that I get. And this is just nothing more than a myth that's been concocted and promoted by Wall Street. You see, Wall Street firms make their living charging a lot of fees for managing people's investments. They've got no interest in you managing your own money and embarrassing the returns that they generate for you. And by the way, charge you a heap of fees for generating. So myths like this are recycled continually. Saying it's impossible to time the market is like saying it's impossible to fly a jumbo jet. It is impossible if you don't have the skill set. But once you've learned how, what once seemed impossible becomes almost second nature. A complete disregard for timing says you have no process, you lack the skill set, and really all you're doing is parroting conventional dogma. So how do we create consistent gains? Well, by trading options. Because as an options trader, you can do all of this. You can make money from rising and falling markets. You can easily control your risk. You can grow your account quickly, and you can generate a regular income stream from the market, a regular consistent income stream. So does that sound good or good? Who would like to know more about how to do all of this? So a little bit of background on options. So let's tell you a quick story about Thales of Miletus. He was the one of the earliest options traders. Now, Thales of Miletus is widely regarded as the first philosopher in the Greek tradition as well. He's the guy who had the quote, "Know thyself," which is emblazoned above the temple at Delphi. He made significant contributions in the fields of mathematics, geometry, and astrology. But in addition to being a philosopher, he was also one of the earliest options traders. So one day, as Thales was walking through the Athens marketplace, he observed the upcoming olive harvest was expected to be particularly bountiful. So he decided to purchase options contracts on olive presses, allowing him to secure the right to buy these presses at a predetermined price, known as the strike price, in the future. Now, Thales believed that demand for olive presses would skyrocket once this bumper harvest arrived and olive production soared. And by acquiring call options on the presses, he essentially bet on the price of olive presses rising in the future without even having to buy any olive presses. Now, this move enabled him to control a significant number of olive presses without having to pay the full price up front. His timing happened to be impeccable. When the bumper harvest arrived, demand for olive presses did skyrocket. He exercised his call options and bought the presses at the predetermined price, the strike price. He then sold the presses at the prevailing market rate, reaping enormous profits. The Thales often pondered the philosophical paradox of risk and uncertainty. He saw a parallel between the unpredictability of markets and the mysteries of the universe. And just as one could not control the stars, one could not control the market. Yet through careful risk management and prudent decisions, one could successfully navigate the uncertainty and emerge victorious. So really, Thales is the early inspiration for all of us traders seeking to navigate the markets prudently and successfully with strong risk control. So what is an option? Well, look, there are only two kinds of options: call options and put options. We buy call options when we think an underlying stock or security is going to go up in price. Just think call up, as in call up a friend. And we buy put options if we think the underlying price is going to go down. And just think put down, as in put down your phone. Now, anybody can do this. Dan was a new member. This was one of his earliest trades, and he made a profit of 850%. And he says, hard to believe I'm making trades like these. Thank you, Simon. You know, people get worried that trading options is complex. It can be made complex. But of course, the key, as Einstein said, is things should be made as simple as possible, but no simpler. That's what we're all about here at Tower of Trading. Another one of our new members closed a bounce trade. It's one of the methods I teach, for a 50% profit. And again, he's up and running and making profitable trades as soon as he's completed the modules. So let's talk about why options are your best option if you want to control your risk and grow your account rapidly. First reason is that options are the best way for us to leverage, there's that word again, a small amount of risk capital into potentially massive returns. Options allow anyone to thrive in any kind of market condition. Third reason is options make it simple for us to manage our risk. Number 4, options can provide consistent opportunities for high probability trading. And last but not least, options are flexible and can be highly profitable in a crash situation when other investments are going down the drain. So let's look at those in a little more detail. So the first reason was options are the best way for us to leverage a small amount of risk capital into potentially massive returns. Capital just means money. So risk capital is money that you're prepared to risk. Options offer leverage. There's that word again. What does it mean? Leverage means large returns on a small capital outlay. With an option contract, you get to control 100 shares of a stock, but you've only got to pay a fraction of the cost. So let's just have a look at this in action. Here's an example in Microsoft. Microsoft yesterday closed at $331.77 per share. So 100 shares of Microsoft would cost you $33,177. Or you could buy one out-the-money call option for Microsoft that lets you basically rent those shares for 30 days, and that's only going to cost you $1,098. Now, if Microsoft rises, the gain you make on the $1,098 outlay for the option could end up being similar to the gain you make on the $33,177 stock purchase. Here's an example in Deckers. We bought a call debit spread here at $4. 7 days later, we sold that call debit spread for $9. Now, the stock in that time frame had rallied 4.4%. That's not bad, right? 4.4% in 7 days. The options gained 125%. All right, so small gain in the stock, massive gain in the options. Here's another example in Match Group. We bought some calls at 405. We sold them at 1205. The gain on the stock was 7%. The gain on the options was 197.5%. All right, so another example of leverage. Second example, options allow anyone to thrive in any kind of market condition. When you own a buy and hold equity portfolio, you're basically hoping that the stock market goes up every day. As an options trader, you relish all market conditions because we're buying call options when we expect the price to go up, and we buy put options when we expect the price to go down. So here's an example of a bearish trade. We bought a put debit spread in Octa at $3.30. We sold it out 2 days later at $8. That was 142.4% gain in $2. Let me ask you, how useful would it be to you to be making gains like this, 142% in 2 days, in a falling market? Another example in Goldman Sachs, again, making money on the downside. Here we're in the trade a little bit longer. We're in the trade for 8 days, but the options gained almost 81% in value on a 4.5% decline in the stock price. So here, another example of leverage, but this time to the downside. Reason number 3, options are your best option, is because options make it simple for us to manage our risk. You see, options offer unlimited upside and limited downside. You might be thinking, hang on, that sounds too good to be true. But this sort of trading even has a name. It's called asymmetric payoff. Asymmetric just meaning two sides are not the same. So your maximum loss is limited to the initial premium you pay for the option up front. So with options, we get leverage, which when combined with high probability moments in time equals smart leverage, plus we get risk control. All right, so when you buy a stock, you've got uncapped upside, which is great, but you've also got uncapped downside. All right, if the stock falls all the way to zero, you could lose your entire investment. When you buy a call option, you still have the uncapped upside, which is great, but your downside is limited to the premium that you paid up front. All right, so options make it very easy for us to manage our risk. Little secret is that options are the finance industry's best risk management tool. Fourth reason options are your best option is that options can provide consistent opportunities for high probability trading. You don't need a heap of different setups. I use 4 setups in my trading. I teach those 4 setups. You don't need to load your chart full of different indicators. Simpler is almost always better when it comes to trading. And with options, you can trade stocks, bonds, gold, commodities, emerging markets, currencies with the advent of ETFs. Here's an example of a trade we took in TLT, boring old bond ETF. We made 78%, and again, this was in 8 days on TLT declining. Here's an example of a bullish trade in gold. We made a 90% gain here, and again, this was in the span of 16 days. Small gain on the stock, large gain in the options. So the key takeaway here, folks, is options offer you the ability to make significant gains on small moves in the underlying stock price, all while limiting your downside risk. The 5th reason options are your best option is they can be highly profitable in a crash situation when other investments are going down the drain, because we can buy put options to profit from falling stock prices. Even in a rising market, you can have 1 or 2 bearish trades on now and then just in case. And importantly, you can use options to hedge your portfolio. Here's an example, recent example last month. I bought some September 455 puts in SPY, the S&P 500 ETF at $6.50, sold half of that position on the 8th of August for an 88.6% gain. And then on the 21st of August, I sold the second half for a 170% gain. That was some very nice protection on a down move in the S&P 500. In fact, my best returns always seem to come at the beginning of market falls. And that's because of my how to hedge module. So the key takeaway here, like I said earlier, options are the finance industry's greatest risk management tool, but not many people want you to know that. So let's talk about some of the differences between trading a bull market versus trading a bear market. Now, don't worry about official definitions. They're subjective and they frankly don't mean very much. Just focus on the prevailing dominant trend. Now, the 200-day simple moving average can provide some very important context about market behavior. I'm going to share with you a quote from Paul Tudor Jones, doyen of the hedge fund industry. He says, "My metric for everything I look at is the 200-day moving average of closing prices. I've seen too many things go to zero, stocks and commodities. The whole trick in investing is how do I keep from losing everything? If you use the 200-day moving average rule, then you get out, you play defense and you get out." The point being, if Paul Tudor Jones is watching the 200-day moving average, you and I should be as well. I call it the Jekyll and Hyde switch. The 200-day simple moving average is widely viewed as the line in the sand between a bull market and a bear market. It's the dividing line between a long-term uptrend and a long-term downtrend. It gets a lot of attention, all right? Basically, everyone is looking at it and aware of it. Professional money managers, hedge fund managers, pension fund managers, they're all aware of it. Markets that are trading above their 200-day moving average are slower, gentler, buy every dip kind of markets. But when a symbol crosses below its 200-day moving average, it's as if it undergoes a personality shift. And that's why I call it the Jekyll and Hyde switch. So markets that are trading below their 200-day moving average tend to have these characteristics. They're faster. They have a faster, scarier feel to them. The news headlines are generally all negative. Bad things seem to keep happening. CNBC is running regular markets and turmoil segments. But the thing is with bear markets is bear market rallies can be ferocious and big enough to convince almost everyone that the bear market is over. Now, markets are easiest to trade when they're happy or bored, and a market that is below its 200 SMA is neither of those things, so you need to have your wits about you. So here's a relatively current chart of the NASDAQ. And what you can see is when it's above the 200-day moving average, the moves tend to be quite small in both directions. Once it gets below, we come back, test it as resistance, test it again, big downdraft, big rally back up to the 200, massive fall, sharp rally, really sharp rally, massive fall, big rally, another big fall. And then look, once we get over the 200-day moving average, the movements become a lot more placid again. All right, so there's that personality shift. Here's an example of the S&P 500 during the global financial crisis. Well, this is in 2005. You see again how volatility is generally fairly low. The movements are fairly small. As soon as we start testing the 200-day, the movements become bigger, and then the moves to the downside become enormous, but so too do the rallies. And then we get back above the 200 and we're off to the races again. Personality shift. Now, the most obvious difference is that during a bull market, stock prices trend higher. During a bear market, stock prices trend lower. So to thrive in a bear market, you need to learn how to profit from falling stock prices, i.e. buying put options. Now, this is a jarring reality for most who are conditioned to believe that stocks only go up. We know that because Google searches out for why did stocks drop outnumber Google searches for why did stocks rise by nearly 5 times. And as you've seen, bear markets have a different personality. They become more volatile, they change direction more quickly and more frequently, and counter-trend moves can be dramatic in a bear market. Now, if you're in a bull market, you can pretty much ignore counter-trend moves. The counter-trend move is a move against the trend. 4% drop, 5.5% drop, 3% drop, 3.6% drop, 5.5% drop. They don't really worry anybody that much. This is the NASDAQ during the tech wreck. Now, during the tech wreck, the NASDAQ declined 83% from top to bottom. But during that time, there were 7 bear market rallies of between 24% and 59%. Now, imagine trying to thrive in this environment without knowing how to identify trends and make money in both rising and falling market conditions. I mean, imagine this, right? The NASDAQ rallied 59% of the September 2001 low, only to make new lows, falling ultimately 83% from the high. Now, between 1969 and 1979, the S&P was a lost decade. And I just have to ask you, have you got a strategy in place for a decade like this? The key takeaway, folks, is that moves against the trend in a bull market can most often be ignored. Moves against the trend in a bear market, i.e. bear market rallies, can be huge and cannot be ignored. So whilst most people think, oh yeah, I'll just make money by shorting stocks, until my eyes fall out in a bear market, it's not as simple as that. You need to trade both sides of the market. You need to trade those bear market rallies as well. If you try and hold short positions through them, it's going to be very, very painful. So let's talk about how to make money in any market condition by exploiting both trend and counter-trend conditions. So let's talk again about identifying high probability moments in time. We want to identify high probability moments in time to expose our money to risk. Now, most of the time, stock price movements are pretty random, but there are moments in time when price becomes relatively more predictable. The probability of outcome A happening becomes statistically more probable than other outcomes. So when doing this with options, we're looking for bullish and bearish opportunities, short-term opportunities. And we can do this either by following the trend or by taking counter-trend setups. So let's define the word trend for our purposes. So when we talk about trend, we're talking about the direction of the price of a financial instrument. Now, trends can be up or down, bullish or bearish, strong or weak, long-term or short-term, nascent or well-established. Now, I'm a trend follower at heart because trend following is like sailing with the wind at your back. You're following the path of least resistance. But how do we find that path of least resistance? Well, I look for what I call rainbow logic. In an uptrend, rainbow logic is defined as this. The 8-day exponential moving average is above the 21 EMA, is above the 34 EMA, is above the 50-day simple moving average, is above the 100 SMA, is above the 200 SMA. And for a downtrend, all you do is reverse the signs. So the 8 EMA is below the 21 EMA, etc. And I color code these moving averages so they look like a rainbow on my charts when they're correctly aligned. So my charts are highly visual, intuitive, and colorful. And when you see this rainbow formation, red and yellow and pink, you know what I mean. Song doesn't work, but when you see this rainbow, you know the path of least resistance is higher and you want to be taking long trades. When the order is flipped and the red line is at the bottom, the path of least resistance is lower and you want to be looking for short opportunities. The important takeaway here, though, is rainbow logic reveals the path of least resistance to you and keeps you on the profitable side of a strong trend. Now, trend trades are relatively easy to find and manage in market environments like this. You just buy the dip, 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 buy the dip. Now, yeah, you'll get a squirrely correctional pullback, once a year. And yeah, you might have some losing trades here. That's just part of trading. But you've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 profitable buy the dip opportunities on that chart with one kind of squirrely one. That's the power of it. And then you can start making trades like this. This is an earnings trade in Lockheed Martin where we locked in 216.7% in 4 days. This was a volatility expansion trade in NEO to the downside. We locked in 100% in 4 days. Now, in a market like this, and this was the S&P in 2022, you need to learn counter-trend setups because the environment is much choppier. And what you think is a strong downtrend can reverse almost without warning. So again, we had these huge counter trend moves in this tech wreck in 2000 to 2002. So with counter trend trading, we're looking to identify high probability market turning points. We're looking to trade short-term tops and bottoms. Now we are betting against the medium-term trend, but these setups can be extremely valuable in volatile, choppy markets where trends have limited follow-through. And I can tell you right now, today, my bread and butter, and for the past week or two, has been counter trend trades because we're in a choppy market environment again. So what we're looking at here is, this is an example of a bullish setup in SMH, the semiconductors ETF. We want to buy calls here and then sell them here. Same chart, same sort of idea, but this time we're looking at bearish trades. We're going to buy puts here, sell them here, buy puts here, sell them here. Here's an example of a counter trend trade we took in Johnson & Johnson. We bought some call options at $2.50. 2 days later, we sold them at $9.55, 282% gain in 2 days. What would be worth to you folks to be able to put trades like this in your own portfolio? Now, they're not all as big as that, but here's another example in Amgen where we made 132% almost in 9 days, again, using counter trend trades. One of our members wrote in to talk about a trade he took in PNC. He says, "Hi Simon, thanks for the PNC info on this month's coaching call. Just sold and made 65%. So on the 18th of April, he bought some 19th of May's 125 calls at 440, sold them on the 26th of April for 725, made a 65% gain on his options, and that was in 8 days. So the important takeaway is that by taking trades both with and against the prevailing trend, you can make money in any market condition. Now, I want to finish off here on the keys to successful risk management. I know it's not sexy, but this is so crucial to your long-term success. Because in trading, we are always dealing with probabilities, not certainty. All right, we grow up going through school with a very deterministic mindset, with a sort of a Newtonian physics approach to the world. If A happens, B is going to happen. As traders, we must develop a probabilistic mindset, which says if A is happen, B is more likely, but anything is possible. Losing trades are just part of the business. They are an operating expense. They're nothing to be afraid of with proper risk management. But like any good business, we want to manage and minimize our operating expenses. And this is where risk management comes in. So risk management in a nutshell is all about drawdown control. You see, if you're in a portfolio and you allow it to drop 50% in value, you've got to make 100% portfolio return just to get back up to break even. All right, so 50% drop requires a 100% return just to get your portfolio back up to break even. This is an enormous task that will break most people psychologically. So you need to manage risk on your individual positions and on your portfolio as a whole. I've got a rule in my trading, and this is what I teach my traders. if you ever get to a drawdown of 15% in your portfolio, if your portfolio ever drops 15%, you sell everything and you go to cash for a minimum of 24 hours. All right, because if this has happened, it means you're out of sync with the market. You need to take some time off, chill out, come back to the market with a fresh pair of eyes. Why 15%? Because I've only got to make 17.6% back to get to break even, and I know I can do this. All right, I'm not struggling with an insurmountable task like this. As I said, not every trade works out. This was a losing trade on Hershey. In fact, I had another losing trade on Hershey today. I just came out of a counter-trend bullish trade and I lost about 3% on it. But critically, the winning trades are much bigger than the losers. All right, we're keeping our losers really small. So some important tips on risk management and trading psychology. Keep your position size small, especially when starting out. The no high fives rule. If ever you feel like high-fiving yourself on how good of a trader you are, go flat. All right. If you think you're God's gift to trading because you're on a hot streak, chances are the market is just about to teach you a lesson. If you are ever having sleepless nights worrying about your portfolio, go flat and trade smaller when you get back into the market. Trade beneath your means. You don't always have to trade at your maximum risk level. This is really important. If your emotions ever waver beyond mild contentment to mild disappointment, you're trading too big. Cut your position size and keep cutting your position size until you can maintain that emotional even keel. The problem is when the emotional brain takes over, our ability to make high quality decisions is seriously compromised. And of course, when we're trading, we want to make high quality decisions. We do not want the emotional brain ruling the show. And seek to book incremental gains rather than trying to hit home runs. We're after consistency of traders. Treat trading the way you would any normal job. Most people go to their workplace with the expectation that if they do what's required of them, they will receive a paycheck. And that paycheck will be the same size as the one they got last month and the one they got the month before, generally. Most people don't go to their place of work thinking, I'm going to earn my retirement this month on a really massive paycheck. All right, and if you keep trading the same way, consistency will come. So let's talk about booking incremental gains. You've seen many examples of trades I've taken that have returned 50% to 100% or more in a matter of days. What would it take to make 5% per month? All right, if you can find just 2 trades per month that make 50% while risking 5% of your NLV, that's it. You're done in 2 trades. If you can find just 1 trade per month that makes you a 100% gain trading options while risking 5% of your month, that's it. You've made your 5% per month goal. And this is a goal I set all of my traders. Azar, he wrote in to say, so far I've closed 8 trades and had a 50% win rate, but he's really good at risk control. So his NLV is up 11% in 2 months. That's 5.5% per month. And he says taking a loss has never been so stress-free before. And that is really the sign of maturity as a trader. Vlad says he said he was just 1 month in. He's done 7 trades. 6 of those closed out with a 50-50 ratio winners and losers. But again, because his risk control is great, his NLV was up 9.5% in his first month. All right. So yeah, totally possible. Again, you find 2 trades that make 50% while risking 5% of your NLV, or you find just 1 trade per month that makes 100% while risking 5% of your NLV. Doesn't sound that hard, does it? All right, and that's because it's not that hard when you've got the right system. 5% per month only sounds implausible because Wall Street has been lying to you your whole life about what good returns are. Let's just have a look at a comparison, right? Wall Street will tell you that 10% per year is a good return. Why? Well, because that's approximately the average annual return of the S&P 500. Now, at the end of year 1, if you start with $10,000 and your annualized return is 10%, you'll have $11,000. That's not bad, is it? By the end of year 5, you got $16,000. Wow. It's not exactly life-changing though, is it? Now, if you can, instead of earning 10% per annum, you can earn 5% per month and compound that. By the end of year 1, you've already beaten 5 years earning 10% per annum. By the end of year 5, if you're consistent and you keep at it, you're starting to look at life-changing returns. So here's an update from another one of our members. Michael said he's made 19 trades so far over the past 7 weeks, 57% win rate. NLV of his portfolio was up 20% in 7 weeks. All right, so yeah, 5% per week, per month is definitely doable. So to summarize, all successful traders have a system to help them identify high probability moments in time to gain exposure to risk, to manage their risk, and to override their gut impulses. And it's usually at about this time people say, well, where can I get such a system? So let me introduce you to Options Academy Elevate, which is our flagship online options training curriculum. The core training is conducted over 60 plus video lessons. There's over 25 hours of content. It's broken down into 7 easily digested core modules, plus some valuable bonus modules designed to get you on the fast track as soon as possible. You get 12 months access to the whole program. You can watch it as many times as you want during the year, anytime you want, and on any device. So let's just do a quick recap of everything that we've covered in this class. Key takeaway number 1 is that lost decades are more common than you probably realize. To thrive in this environment, you need to know how to make money in both rising and falling markets. And Options Academy teaches the very methods you need to be profitable in rising, falling, or crashing markets. Key takeaway number 2 is that options offer you the ability to make significant gains on small moves in the underlying stock price, all while limiting your downside risk. Options Academy offers the easiest, most engaging options trading program on the market. Key takeaway number 3 is that options are the finance industry's greatest risk management tool, and professional risk management techniques are the foundation of the Options Academy methodology and our highly regarded How to Hedge program. Key takeaway number 4, moves against the trend in a bull market can most often be ignored. Moves against the trend in a bear market, i.e. bear market rallies, can be huge and simply can't be ignored. Options Academy reveals high probability setups for both trend and counter trend trading. Key takeaway number 5, Rainbow Logic reveals to you the path of least resistance. Rainbow Logic is an Options Academy trend identification technique that makes trend identification visual, intuitive, and fun. Who doesn't like having color on their charts that helps keep them on the right side of the trend? Key takeaway number 6, by taking trades both with and against the prevailing trend, you can make money in any market condition. And Options Academy is the way to build abundant wealth in any market condition. Key takeaway number 7, all successful traders have a system to help them identify high probability moments in time to gain exposure to risk, manage their exposure to risk, and override their gut impulses. And Options Academy provides traders with exactly that system. So let's just look at it in a little more detail. Module 1 teaches you the fundamentals of technical analysis. You'll learn how to read price action like a book, identify trends, how to identify support and resistance, and how we use a few common indicators in uncommon ways, so you'll be able to identify those high probability trading opportunities. Module number 2, I talk about the bounce setup. This is my favorite trend following setup. It's broken down for you in great detail in the videos, and this setup alone will have you on the path to profitability in any trending market, whether it's up or down. Module 3, a volatility expansion setup. We're looking here for stocks that have gone quiet and storing up energy from a big move, and many explosive profits come from this setup. Module number 4 is the explosive earnings setup. 4 times per year, US companies report earnings. You'll learn a high probability setup with significant edge that takes advantage of earnings season with explosive results. Module number 5, we've been talking a lot about risk management today. Here's where it all comes together. So important, because even the best setups in the world are not enough to ensure your long-term success. For that, you need a professional risk management framework. And in Module 5, you'll learn to control your risk to ensure consistency and your long-term trading success. Module 6 goes through trading psychology, and many of our members tell us that this was their most favorite module, because not only did it improve their trading, it improved their lives. You'll learn the path to become a relaxed, focused, consistent, happy trader. You'll approach the markets with confidence rather than fear, and you'll view volatility as an opportunity, not a threat. Not obtaining the proper mindset is why success eludes so many aspiring traders. Module 7 is where we teach counter trend setups. You'll learn how to identify and trade high probability turning points. Like I said, in choppy markets, these are worth their weight in gold. You'll learn techniques that will enable you to pick high probability tops and bottoms, and you'll profit from the opportunities offered in fast, volatile markets. You'll also get access to a highly acclaimed How to Hedge program where you'll learn the advanced risk management techniques used by hedge funds. Here you can protect yourself from extreme market events and learn how to identify when they are most likely to occur ahead of time. You'll also get the ultimate guide to debit spreads. This will teach you how to reduce your risk, minimize your cost per trade, and mitigate your exposure to time decay using debit spreads. This program is fantastic, and if you're trading with an account size less than $50,000, it's a must-have. You'll also get to learn how to use diagonal spreads, which is another great way of trading earnings, and you'll also get these bonuses, which have been really designed to fast-track your success. You get access to my highly acclaimed Options 101 online workshop. This is delivered in a simple and engaging manner with no fluff. Even if you've never heard of options before, you'll be up and running in no time after completing this module. You'll get modules on setting up your charts. I'll teach you how to set up your charts so they look exactly the same as mine, compatible with both TC2000 and Thinkorswim. This will save you loads of time and ensure that you're seeing what I'm seeing. You'll get cheat sheets and blueprints, so you'll have quick access to all of the trading methods. Scanning criteria, these are a game changer because I will share with you the exact scans I use to find a short list of trade setups within seconds, saving you hundreds of hours of time. Again, compatible with Thinkorswim and TC2000. You get invitation to our private LinkedIn group. Why trade alone when you can join our LinkedIn group and network with a global network of traders? We've got members from over 40 countries these days. You'll also get 12 months of support covering any issues you may need. So when should you do this? Well, what if you waited another 3 years to get started? All right, in 5 years' time, instead of having $335,000 in your account, potentially you'd only have $32,000. So inaction is a choice, and it's a choice that potentially has a significant opportunity cost associated with it. So let's just recap everything you're going to get. You get 1 year access to the core video lessons worth $1,997. You get the Options 101 online workshop valued at $497. You get the setting up your charts modules worth $497. You get the ultimate guide to debit spreads worth $497. You get the how to hedge module, trades on our website every day for $497 just this by itself. You get the field guide to diagonal spreads worth $197. You get all of the trade blueprints worth $497. The scanning criteria, look, this is probably worth multiples of that when you count how many hundreds and thousands of hours of your time this will save you in your career as a trader. Access to our private LinkedIn group worth $497. 12 months of help desk support worth $497. You're also going to get 1 free month of Options Academy Accelerate worth $297. Total value is $6,467, and it is worth every cent of that. But you're not going to pay anything like that today. $6,467 in value. You won't pay this today. I want to acknowledge you for attending this workshop. You've watched through to the very end, and that shows me that you're serious about improving your financial situation, and I want to recognize that. And as a thank you for your commitment by giving me your time, I'm going to give you a massive discount on this program. So on this workshop only, you can claim this entire package for just $997. Head over to this website, toweroftrading.com/traders to take advantage of that. Now, let me talk about the super special bonus. I'm going to give you 1 free month to my flagship coaching program called Options Academy Accelerate. Here, you will receive a video from me each trading day discussing market trends, macro developments, and you get to look over my shoulder at all of the trades I'm taking in my personal account. I give you the levels, I tell you where I'm entering, where I'm exiting, where I'm taking profit, where I'm cutting losses, and also why I'm doing everything. You get invited to a bi-weekly webinar, and you get access to a monthly market barometer. This sells every day for $297 per month, but I'm going to give you 1 free month to try it out, and you can take this for a spin at any time during your first 12 months. So $6,467 value, but on this workshop, you can claim everything we've just talked about for $997. And all the risk is on us, because you're even going to get a 14-day risk-free trial. We are so confident that you will love what we're teaching you. If you decide that for whatever reason you don't like it, let us know. We'll give you a refund. Also, exclusively for the first 10 action takers, you will receive a 30-minute one-on-one Zoom call with me worth $300. So really looking forward to working with you to take your trading to the next level. Head over to that website, toweroftrading.com/traders, and take advantage of this super special offer, just $997. That's all I have to share with you today, folks. I'm really happy to open it to any questions.
All right, everybody, now is the time to ask. We've got about 15 minutes, so there's some really good stuff in here that you're going to want to ask about. I really was intrigued with your rules. And, you know, the whole thing of if your account is down 15%, you need to cash it out and go cash for 24 hours. That's pretty extreme, isn't it?
I think it's a lifesaver. You see, what happens to new traders so often is they might have a few trades that are making losses. Maybe there's a sudden market turn they weren't anticipating, and they can get caught like a deer in the headlights.
Man, I love it.
Or they can sit there hoping that things turn around. You've heard the saying, hope is not an investment strategy. If you're
Right.
hoping that the market does something, you no longer have an edge. And if you no longer have an edge, you're best just getting out of that position and going to cash. And the fact is, if you're down 15%, it is absolutely recoverable. If you're down 50%, you can end up sliding down a very dark psychological spiral.
Oh, yes. I think lifesaver is actually, I was saying it's extreme because I mean, it's like cash out, really? But yeah, to like draw that line in the sand and then not go past it, that's, uh, yeah, life saving. Um, how did you get to Singapore? I mean, your accent tells me are you Australian?
I am Australian. I was working for Goldman Sachs. I got headhunted by Citibank in
Nice.
Singapore.
Mhm.
I took the job, and I met the love of my life up here. My
There
wife
you
is
go.
Singaporean, and that's why I'm still here.
That usually is how it goes, I think. When we find the right person, then it doesn't matter where we live because they're home, right?
Right.
I'm in Canada. I'm a Florida girl, so I can
Ah,
totally
right. Okay.
relate to you.
That's a
Um,
different climate for you.
yeah, you know what? People said to me, "How are you going to manage the winters?" And I said, "Well, I don't really know, but you know, there's coats and there's heaters and it turned out that it's almost the same, except that in northern Ontario, you race from the car to the house to stay warm, and in southern Florida, you race from the car to stay cool.
Right.
So it's exactly the opposite. And the first year I was here, I said everybody was giving me a hard time about, you know, getting through the winter, but that summer it was 104 degrees Fahrenheit where we were, which is like 12 hours north of Toronto and should not have been that hot at all. And
Oh,
I said,
wow. Okay.
little did I know I would come so far north to die of heat stroke.
Yeah, right. The irony.
So, I'm not seeing any questions here, which tells me that people are either you told them everything they needed to know or they're not paying attention. And I don't think that could be the case, right? Yes, right. So what we're going to do is go back over what they're going to get for the 997. And folks, I want to tell you something. You're going to get email from every single speaker who comes in today. And the good news is it's just email. So if they're a good fit for you, take part. And if they're not a good fit for you, well, then you just hit the little unsubscribe button. It's no big deal. So, oh my, look at all this. Go ahead,
So
Simon.
look, what you're getting is the keys to the kingdom. All right. You're getting a thoroughly designed curriculum that will take you from a beginner to professional standard trader. All right, and the way the course has been designed, it's been designed very deliberately in terms of its structure, to just follow it in order, and it will teach you everything that you need to know, even if you're more advanced. Okay, we've got people from all walks of life in our program. I've got former Goldman Sachs guys. I've got former hedge fund portfolio managers. I've also got school teachers and yoga instructors. All right. So, and like I said, we've got people from over 40 countries around the world. We've got dozens of unsolicited testimonials on our website. Yeah, it works. All right. This program works, and it's delivered in a way that is fun and easy to digest. There's no complex math, and it's but people really enjoy it. We've had people go through the entire program within a weekend. I would say most people take 3 to 4 weeks to get through it all. But it's just to show you that it is very easily digestible. It's not difficult. The videos would be between 10 and 20 minutes in length generally, so that they're easy to digest, and you've got the cheat sheets and trade blueprints as well.
Nice. All right. Well, I appreciate you joining us. It is almost 11 p.m. in Singapore right now, correct?
It is indeed.
Well, I thank you so much for joining us. If you have anything else to add, I would be happy to keep you on with us, however you want to do.
Look, I would just say if you've got any desire to achieve consistent results trading options, give us a go. We'll keep this offer open, Sherry, until the end of the weekend. All right, until Sunday.
Perfect.
So if people want to do a little bit more due diligence on me or the Tower of Trading, you can just head over to our website, towertrading.com. Don't use this URL, all right, towertrading.com/traders, because you won't see that anywhere else, and you won't see this offer anywhere else. But yeah, we'll keep the offer open until the end of the weekend, and yeah, give us a try. To test it out for 14 days.
Sounds
I think
good.
you'll love it.
And to check out the actual website, you just don't put the /traders on there, right? You just go
That's
to
right. Just go to towertrading.com.
towertrading.com. Moomoo is our sponsor for September. With Moomoo, you get free access to real-time LV2 market data of US stocks. And for a limited time, join 19 million Moomoo users and get up to 16 free stocks, including Tesla or Google, when you register for a new account with this link, and you fund it with at least $100. So the way it works out is for the month of September, deposit $100, you get 5 free stocks. If you deposit $1,000, you get the 5 free stocks plus 10 free stocks. And if you want to have a $5,000 account, you get the first 2 tiers plus 1 free share of Tesla or Google.